Hi everyone. On October 7th, 2022, RBI announced the phased introduction of digital rupee launch, which will be India's very own alternative answer to the cryptocurrency craze sweeping the globe. RBI since the beginning has had a rocky relationship with the existing cryptocurrencies and does not support the proliferation in the market, which is evident from RBI's move to cut crypto startups from the country's payment network, and then announcing a crypto tax regime which levies a 1% transactional tax, thereby decimating the volumes on crypto exchanges. This digital rupee or e-rupee or CBDC, which stands for Central Bank Digital Currency, will bring in an additional option to all the available forms of money today, especially to the existing cryptocurrencies, and is said to solve numerous problems plaguing the financial system of not just one country but rather the globe. So in today's episode, let's try to understand the concepts and premises behind this digital rupee, why there is a need to introduce a digital rupee, and what are the challenges that the digital rupee might face which could turn it into a total catastrophe. People, going forward, for the sake of simplicity, I will be referring to the digital rupee only as CBDC. So in order to understand what is CBDC, let's set the context as to why CBDC is needed at all in the first place. You see people, unfortunately the Indian finance and banking system has been facing a ton of problems in the background which either have or likely might result into a nightmarish situation. To start off, did you know that for printing every 100 rupee note, it costs RBI 15 to 17 rupees? This translated to an expenditure of approximately 5,000 crores for printing securities during 2021-22 and more than 4,000 crores in the previous year. And to further add to the woes of RBI, as demand for smaller denominations increases, this cost shoots up. Furthermore, the transportation of physical currency notes to remotest parts of India's geographic stretch to fulfill the currency flow in the economy incurs yet another huge logistics cost. Secondly, despite the introduction of UPI and digitization of the payment space, India is the only country where the cash in the economy has shot up. The percentage increase in the value of currency notes during 2021 and 21-22 was 16.8% and 9.9% respectively, whereas the percentage increase in the volume of currency notes during the same period was 7.2% and 5%. This clearly shows that post-pandemic, the demand for cash is still on the rise, and digitization has failed to fulfill its objective to tame the physical currency beast. Thirdly, UPI although has been a boon for the country's payment system, but it still has gaps in the form of transactional failure rate of 1.2 to 1.3%, which need to be filled. This number might seem small, but imagine this as a portion of billions of transactions being done per month worth trillions of rupees, and you will identify the need for improving the efficiency of the system by reducing the settlement risks and the incidence of such transaction failures. Fourth, as per a Reserve Bank of India survey, the private sector bank charges on money transfers can go up to 12.6% for transfers to India under $200, whereas the average cost of remittance was 2.9% of the total amount being sent. And guess what? As per the World Bank, India is the world's largest recipient of remittance, with remittance figures reaching $87 billion in 2021. Therefore, cross-border transactions form a critical area of focus to introduce more cost-effective, easier and faster modes of payments. And most importantly, the Indian banking system will always be under the shadow of no credit or liquidity risk issue, in which case the Indian population's love for physical cash might create a spurt in demand to convert a substantial amount of bank deposit to cash, which might lead to credit or liquidity risk for the commercial banks. This is evident from Russia's example, where global sanctions on Russian economy resulted to a panic-stricken population creating bank runs on commercial banks in order to get their bank deposits back in the form of hard currency. These are just some of the numerous problems we have in our banking and financial system, because of which it has not just become costly and inefficient, but also has slowed down the progress of one of the biggest economies of the world. And this is why it has become imperative to introduce the CBDC. So the question arises, how will CBDC help in mitigating these issues? Well, RBI is starting the pilot test for CBDC so that the unforeseen issues could be identified before launch. The RBI will be the sole entity responsible for issuing and regulating the CBDC, which will be issued in two forms. The retail version, meant to be circulated for consumers like you and me, and the wholesale version for the interbank settlement of funds. But you know what, people? The biggest catch over here is for CBDC, RBI has said that it won't be necessary for anyone to hold a banking account. And this is because of two sound arguments put forward by RBI, which are also CBDC's biggest advantages. Number one, instead of opening accounts with commercial banks, there will be wallets where CBDC can be deposited and kept. This is because a wallet is a non-interest bearing digital currency storage instrument which will be reduced the liquidity risk we talked about earlier. But the question is how? Let's consider a situation where your wallet could bear interest on your CBDC. Then everyone would be transferring their deposits from the bank account of a bank X to the wallets. This would lead to bank X's liquidity getting depleted and the bank would be vulnerable to bank run or bankruptcy. But since in reality, the wallet does not bear any interest for the depositor, this situation will not occur because the bank X's savings deposit account still offers better monetary benefit to the customers, which will motivate them to park their most of the funds in this account and a portion of their total funds in the wallet, thereby reducing the risk of the bank or liquidity crisis. Number two, since the CBDC will be available to be transacted offline, this will as a result enable people living in regions with poor or no connectivity to use their wallets. And this will create a digital footprint for the unbanked population in the financial system. And this will result in easy availability of credit to them, which will as a result boost the financial inclusion of the nation. And in case you didn't notice, this also helps in reducing the cost of cash management, because an increased digital footprint means more digital transactions in the economy and thus lesser demand for physical currency and its printing. Now, since we have understood what CBDC is, the big question now is, what then is the difference in current UPI based system and this new CBDC system? To answer, let's first understand how UPI framework works. Let's suppose Vicky wants to send money to his friend Raju via UPI. So he will first make UPI request by logging into his UPI app. This app will then send a payment creation intimation to the app payment service provider, also known as PSP. This PSP will send this intimation request to NPCI network, which will in turn send it to Raju's PSP for authentication. And once NPCI receives authentication back from Raju's PSP, then the issuer bank, which is Vicky's bank, will debit his account and send a debit response to NPCI along with funds. Now, after receiving this response, NPCI will send the funds to credit with credit request to Raju's bank, which will send back a credit confirmation back to NPCI upon receiving the funds. And finally, NPCI will send payment status request to Raju's PSP, who will end the process by sending back a payment status confirmation back to NPCI to close the whole process. Whoosh, I know. Who would have thought a simple UPI transaction would involve so many players and so many responses and would be this complex in the background? Well, this is exactly why CBDC will involve RBI as a central entity and commercial banks as intermediaries with their wallets. To make the CBDC transactions from one bank's wallet to another will be far too simpler and easier, because the lack of multiple entities and the deprecation of so many payment requests and confirmations will provide three major advantages. 1. Since the transactions will be done directly under RBI's ambit as the central entity in the process, hence the failure rate of UPI will be totally eradicated for CBDC. 2. Similar to the failure eradication, the delay in payment processing, which sometimes takes up to 48 hours due to the complexities of UPI process, will also be reduced to instant and real-time windows. And third, reconciliations and other payment issues, if in case any, will also be resolved in real time because of RBI's direct model approach. So now the next question arises that what is this direct model approach? Well, for the issuance and management of CBDC, RBI has introduced two models, the direct model and the indirect model. In the direct model, the RBI will be the lone entity responsible for opening the wallets, bookkeeping, transaction verification, and most importantly, direct involvement in payments. The main objective behind introducing this kind of model is to introduce a robust system which will help in settlement of claims with simplicity and instantly. because all the information regarding the retail account balances will be readily available to RBI with its payment servers. But on the flip side, there is also a major disadvantage to the model in the sense that because all the operations are being carried out by RBI itself, including the customer onboarding, KYC, AML checks, this as a result will lead to huge additional burden which might prove costly and difficult to manage by the central bank of the nation. And this is why the indirect model is introduced simultaneously, which will introduce intermediaries such as banks and financial institutions to the equation who would hold the CBDC in their own wallets. And as a result, the obligations of these wallets would also reflect on books of these intermediaries instead of RBI. RBI's role will then be majorly involved in tracking the wholesale CBDC balances made to these entities and ensuring smooth flow of CBDC operations in the system, thus relieving major burden off of central bank's shoulders. Apart from this, the cross-border payments advantages due to the simpler, optimized and resilient models and systems are there as well. But the RBI is yet to finalize on the model to be implemented since it will involve standardizing connectivity and interoperability along with foreign exchange protocols, so let's skip that for now. So coming on to the last segment of the episode, which is the challenges the CBDC could face, which could reduce it to just proof of concept instead of a full-fledged innovation hub. 1. Since CBDC is totally a new concept, it is always difficult to create an effective adoption for something new amongst the masses. And even if they adopt it in everyday use, the stickiness enhancement to make it a default part of the system will pose the biggest challenge. 2. The expectations from this new concept to protect the consumer's rights and interests will be exactly the same as for physical cash, and hence the measures and requirements for legislations around CBDC will need to be tailored accordingly for mitigating the digital risks and transaction frauds. And this, ladies and gentlemen, brings us to the key takeaways from today's episode. To reiterate, CBDC will provide freedom from the limitations which have been plaguing the banking and finance sectors, such as cost of cash, failure rate of UPI, failure to digitization to reduce the cash in the economy, cross-border remittance charges, and unforeseen liquidity risks. This system could be a game changer if implemented with meticulous planning and can contribute to elevating India's economy one step further in the digital domain. If you found the content to be useful and educational enough, make sure you like the video and subscribe to the channel for more such content. I will see you all in the next knowledge-filled episode. Mindfulness signing off.